So what if I told you that one of the absolute best ways to win in the stock market is to invest in the companies that everyone else is completely ignoring? We're about to dive into a strategy that basically flips conventional wisdom right on its head. It suggests that the real value, the real wins, are hiding in plain sight, but in the most unpopular corners of the market.
I mean, think about your own gut reaction. When you hear about some hot news stock that everyone's talking about, what's your first instinct? Is it to jump in before you miss out? We are all naturally drawn to what's popular, right? But what if that popularity itself is actually a trap, one that's designed to give you lower returns? There's a certain comfort in running with the herd. We see a stock getting all this media hype, it's got massive trading volumes, and we think, hey, that must be a safe bet. These are what you'd call the glamour stocks. They're the big names, the A-listers, and for decades the common wisdom has been, chase them.
But what if that entire intuition is just completely backward? What if chasing those popular, high-volume stocks is the very thing that's been holding your portfolio back? That is the big question we're going to dig into today.
Okay, so to really get this, we first need to look at the pillars of investing that everybody already knows. Most professional strategies, the ones you hear about all the time, are built around just a few well-known ideas or styles.
And you've almost certainly heard of these, right? The big three investment styles. You've got size, which is all about pitting small companies against the big guys. You've got value, that classic hunt for a bargain for those undervalued gems. And then there's momentum, which is basically just betting on what's hot and hoping it stays hot. For most of modern finance, this has been pretty much the entire playbook.
But the research we're looking at today makes a really compelling case that there is a fourth major style. One that's just as powerful, maybe even more so, and it's almost completely ignored in the mainstream conversation.
And that missing piece is called liquidity. And honestly, it's shockingly simple. It's a strategy that's based entirely on how often a stock gets traded. But here's the crazy part, the radical twist. Instead of chasing the stocks that everyone is buying and selling like crazy, this strategy does the exact opposite. It actively hunts for the wallflowers at the party, the unpopular, thinly traded stocks that nobody's paying attention to.
So how does this actually work in the real world? Well, it creates this head-to-head battle between two completely different ways of thinking about the market. So on one side, you have the popularity strategy. It's dead simple. Buy what's hot. If a stock has a ton of trading volume, you buy more of it. Easy. But on the other side, you have the contrarian strategy. And this is where things get really smart. It's looking for a mismatch. It's trying to find companies with really strong, healthy earnings that, for whatever reason, nobody is trading. It's basically a systematic way to find those hidden diamonds in the rough.
And the logic here is it's incredibly elegant. Look at this process. For any company, you ask two simple questions. First, how much of the market's total profits is this company actually making? And second, how much of the market's total trading attention is it getting? Now, if a company is an absolute profit powerhouse, but it's a ghost in terms of trading volume, guess what? You invest more. But if it's all hype, all volume with kind of weak earnings to back it up, you invest less, or not at all. It really is that simple.
All right, so the big question, does this contrarian idea actually work? Well, researchers put it to the test. They ran these two strategies against each other, backtesting them over a 37-year period. And the results? Well, they're pretty staggering.
Just look at this chart. The contrarian liquidity strategy delivered an average annual return of almost 13%. That's not just good. It absolutely crushed the S&P 500. And what about that popularity strategy, the one that chased the crowd? It actually underperformed the market average. Following the hype was literally a losing game.
But it's not just about the raw returns. It's about smart returns. This table shows the risk-return ratio. Basically, how much bang you get for your buck, how much reward you get for every unit of risk you take on. And the liquidity strategy is the clear winner here, with a score of 0.82. It's just a more efficient way to invest. Chasing popular stocks, on the other hand, well, that gave you less return for more risk. It's the absolute worst of both worlds.
So let's put this in real money terms. What does this look like over the long haul? If you had put just one single dollar into that popularity strategy back in 1972, by 2009, you would have had about $50. Not bad.
But if you'd put that same dollar into the contrarian liquidity strategy, wow, it would have grown to over $200. That is a fourfold difference. This just brilliantly shows the incredible, staggering long-term cost of chasing hype instead of substance.
Okay, so the results are undeniable, but it leaves you with this big question, right? Why does this work so well? Why is going against the grain, in this case, so incredibly profitable? Well, the research points to 3 really powerful reasons.
They are called the equilibrium, the macro, and the micro arguments. Let's break down each one. First up, the equilibrium argument. Think of it like this. The market makes you pay a premium for convenience. Everybody wants stocks they can buy or sell in a split second, right? So those super liquid stocks get bid up in price, which means their future returns are naturally going to be lower. By being the person who's willing to hold the harder to sell, illiquid stocks, you get them at a discount. You're basically being paid a bonus just for your patience.
Second, we have the macro argument. Look at these numbers. Over the last 50 years, the sheer amount of money just sloshing around in the financial markets has absolutely exploded. The world has become way more financialized. Now, as this giant wave of cash poured into the market, it made all stocks easier to trade. But think about it. A stock that was already super popular and easy to trade didn't change all that much. It was the forgotten, illiquid stocks that saw the biggest benefit, giving them a massive boost in valuation.
And finally, there's the micro argument. At its core, trading volume is really just a proxy for hype. When a stock becomes glamorous and everybody's piling in, its trading volume just goes through the roof. This liquidity strategy is specifically designed to automatically avoid those situations. It keeps you out of speculative bubbles. Instead, it systematically puts your capital into those overlooked, out-of-favor companies that are just quietly producing real value.
So, at the end of the day, it all comes down to this choice. We live in a world that is constantly screaming at you to follow the crowd, to chase the hype. But this research whispers a different secret, that true, lasting value is often found where nobody else is even looking. So the next time you think about investing, ask yourself, are you going to chase the temporary glamour of the crowd, or are you going to hunt for that undiscovered diamond?